The enterprise content management space is projected to be $67 billion by 2022. That's massive. Much like my good friend here, the big Tusker elephant. Whether you're focusing on a $67 billion content management space or the $700 billion trucking and logistics space or the $12 trillion transportation industry, I believe a singular adage is still true. And that is, how do you eat an elephant? This is not a trick question. How do you eat an elephant? One bite at a time, right. And I would argue that that's exactly the same approach that you have to take if you want to build a multi-billion-dollar software company or whatever industry that you're in. One bite at a time. Now, I'm going to venture to guess that most of you are trying to service a market that is likely fairly large, and then by default, you will likely have multiple products that you're going to offer to your customers, whether that's you through acquisition or through development. So, knowing when to actually introduce a new product into your portfolio, knowing how to transition from a single product company to a multi-product company, and knowing what not to do is what we're going to spend the next 25 minutes talking about. You cool? You with me? Now, some of you guys might be wondering, well, like, who the hell am I and why am I up here talking about this? Because the truth is, I most definitely am not a product manager. I'm not on the product side. I'm a go-to-market guy. But fortunately enough for me, I spent the last 15 years at Salesforce, Google, Oracle, Box, all in the early days when they were single product companies as they transitioned to multi-product companies. And I got to learn what works and what doesn't work. Because on the go-to-market side, we unfortunately suffer from all the decisions that you guys make as product managers without telling us. And it's a giant pain in the ass when you're trying to go to market on a product that you didn't even know was coming out or you didn't even know you were acquiring. My current role today is I'm a growth partner at Emergence Capital. We are an early stage venture capital firm in the Bay Area, down in San Mateo. We invest in Series A and B stage companies. We're hyper-focused on B2B enterprise SaaS companies. We're the first investors in Salesforce, in Box, in Yammer, in SteelBrick, ServiceMax, SuccessFactors, Viva. We've done all right. It's all right. Fundamentally, we believe in investing in people and companies that are focused on changing the future of work. Now, as an early stage investor and as a former operator at some iconic companies, I think it's safe to say that I've learned a few things. In particular, I can tell you the two primary reasons why early companies fail. One, lack of focus. Two, hiring. What I mean by hiring is you hire the wrong person at the wrong time. At Box, when there was 300 people, Box.com, right? You think that's a hell of a brand. You got Aaron Levy, this crazy fanatical CEO who was like 22 at the time. And yet, at 300 people, we had 2 VPs of marketing and a VP of brand. What? Why do you need that? Be really careful about the people that you hire. Often, especially in early stage companies that I see, they think, oh, I need to go out and hire a VP of sales. Let me go hire somebody from Salesforce or Oracle or Workday. It's like, no, you don't. Because guess what? All the process has already been built for them. Their job is to go execute. So it might not be a good fit for you. Get your first and early hires right. Oh, by the way, your first hire, head of customer success. Your second hire, head of marketing. Your third hire, head of sales. Crazy, I know, but it's true. We'll explain later. The other piece is focus. What I mean by focus, and I mean this is so important, but make sure you just follow a single course of action until you nail it. Whether that's dominating in your market, we were just talking about this, whether that's dominating in your market or in a particular industry or with a product. Nail it. What we typically see is early stage companies that try to be all things to everybody. You get a bite from a big company in enterprise, yet most of your customers are in the SMB or mid-market space, and you decide to go after that enterprise company. Maybe you're not ready yet. Maybe they're not ready yet. You got to be really, really careful about when you go after a new industry or a new market or release a new product. So speaking about new products, let's talk about when to start to add new products to your portfolio, whether that's through acquisition or building them. Now, all those companies that I mentioned earlier have always lived by a certain ethos, which is win the battle that you're in before you go fight another battle. If you think about it, the company, the Oracles, the Microsofts, the Salesforces, the Boxes of the world, they all started off as a singular product. And then over time, they started adding more and more products, which makes things much more complex. The question then you have to ask is, at what point did they decide to add a new product? At what point did Salesforce say, okay, core CRM, this is good enough. I'm now going to go after customer service. We thought about it for a really long time, but there was a certain tipping point that said, okay, now it's time. The market is ready. Let's talk about what that tipping point is, because every single company goes through this. The tipping point is when a company actually recognizes and determines their core product's life cycle. There are 4 stages in a product's life cycle. You guys all know this. I'm not educating you on this. There's what? The introduction, the growth, the maturity, and the decline stage. I'm going to talk about each one of these real quickly. It's important that you can identify where your product is today. If you're early stage, most likely you're in the introductory stage, or maybe you're in the growth stage. If you are, congratulations. And if you're in that stage, and you've got an ARR of roughly 1 to 2 million, come talk to me afterwards. Let's talk about each one of these stages real quickly. The introductory stage, when you're in this stage, you're focused on raising awareness. You're just trying to let everybody know that you exist. You go to conferences and you talk to everybody and then try and get people to try your product so they can give you feedback. All you're trying to do is get on the map, get on people's radars. It's kind of a fun stage. You get to test a lot of different things. This is where you're doing a lot of A/B testing, and you should be taking copious notes on what works and what doesn't, and make sure that everybody else in the company is on the same page. Super important. In the next stage, in the growth stage, we're now focused on accelerating the growth, accelerating our market share, and really focus on market penetration. This is where we're putting all of our resources behind going quickly. Right? This is when you go out and you raise your Series A, and you're like, great, cool, we need to go hire a whole go-to-market team. That's what I said before. Hire customer success first, then marketing, then sales. Why? Well, listen, think about it this way. If you're the founder seller, like what Pete was talking about, as founders, you guys should be out selling the product. The first thing you want to do is, once you get some customers, is you want to make sure that they're wildly successful and happy. So hire customer success folks to make sure you do that. Then hire a marketer, because all you want to do is make sure you can feed your salespeople. If you hire salespeople too early, they're going to starve, because guess what they're doing? They're just pounding the phones all day long, hunting for business. Customer success, marketing, and sales at this stage in particular. The next stage of your product development lifecycle and evolution is what's called the maturity stage. Your task here is all about maximizing your profitability. So we've got significant market share, and now we need to make sure that we're making as much money as possible, and we're defending ourselves from all of those little ankle-biter competitors. Now, the truth is, at this stage, you may decide that you need to launch a new product and not focus on revenue from that product, because all you're trying to do is block and tackle a competitor that is making a ton of noise in your space. That's okay. Just be really clear about why you're launching that product and what it's going to do for you and your organization. Super, super important. The last stage is the decline stage. In this stage, you're kind of thinking about, well, is there a way in which I can actually boost our profit margins once again? Or is it time to phase out that product and to shift gears altogether? It's a really interesting question. Now, at what point should you be thinking about launching a new product, launching into a new market, or focusing on a new industry? We've got, what, introduction, growth, maturity, and decline. What do you think? Thank you. Maturity stage, right? Because you're maximizing your profitability. You're in the place where you're like, okay, cool. How do I maintain quarter over quarter, year over year revenue and growth? And your investors and your board, all we want to do is see everything's moving up and to the right, right? So when you start to get into the maturity stage, maybe it's time to start thinking about what's next, or what can we add that's not going to confuse the market. So do an assessment. Where is your product today? How long do you think it's going to take you to get to your next stage? What's it going to take to get to maturity? And then at that stage, what makes sense next? It helps you in your planning. Yes? I am assuming that you have some sort of product market fit, which, by the way, you are doing when you're in the first two phases, if you will, in the introduction and the growth phase. Actually, the introduction phase, you're really testing your product market fit. Once you have product market fit, then you go into the growth phase, right? Now we're making cash, hiring all my salespeople, right, to go out and execute. And now I'm hitting maturity, I'm hitting my stride. I'm now thinking about what's next. Yes, absolutely, good point. Okay, so next thing to consider. The reality is every product that you introduce is going to go through its own product life cycle. Some are going to be long, some are going to be short. The truth is every single product that you introduce, again, whether that's something you acquire or something that you build, you have to think it's going to have its own go-to-market strategy. It will. And so the interesting thing is making sure that those go-to-market strategies align. Do not do this in a vacuum. Far too often, as companies start to grow, we create silos. Product is over here, engineering's over here, and then you got sales over here, and then customer success and support are way over here, and nobody's talking to one another. And that's a massive, massive problem. It will get you into all sorts of trouble. So before you think about launching a new product, buying a company, or launching in a new market, there are some very important questions you need to be able to answer. One, make sure you're clear about where your current product is in its product development life cycle. Two, make sure you can answer these 4 questions. Very important. Question number 1, do the new products actually fit into our corporate vision and strategy? Is this going to be a distraction? Do they fit into our corporate vision and strategy? Actually, guess what? Let's rewind for a second. Do you actually have a corporate vision and strategy? A lot of the companies that we work with in Series A, one of the first things we do is like, what's your mission? What's your purpose? Why do you exist? Why do people want to come work for you? Because the problem is, in the early stage, in the seed stage, what are we doing? We're just trying to build a product where we can get to product market fit. And then all of a sudden we get some success and we're like, sweet, let's go hire a bunch of people because we raised some money. And they're like, okay, cool, but why do you exist? What's that North Star? Right? So if you're going to, when you kind of reach that maturity stage and it's time to go out and buy a company, I'm going to use SalesLoft as an example, Series C company, one of our companies, they went out and bought a company called Note Ninja because they're in that mature stage of their core product. And Note Ninja, the company, actually fits really well into their vision and strategy as an organization. So first question, does this new product or new company that you're thinking about acquiring fit into your vision and strategy? And it's not really about a matter of will they cause distractions from achieving our goals. The question is how do we manage those distractions? Because anytime you buy or introduce a new product or buy a company, there's going to be some distractions, period. How do you mitigate that and handle that is super important. Third question, is it going to confuse your existing customers? I don't know why enough people don't stop before they make a big decision and actually go talk to their customers and try and understand, what do you think by adding this product or buying this company actually will do for us and for you? Is this going to be beneficial to you? Do you care? Because what you're trying to do is figure out, well, how are we going to position this? Is this going to be something totally separate and different from what our core offering is? Or is this going to be integrated into a cohesive story? If you're not thinking about these things, you're making us on the go-to-market side really sweat bullets. Because guess what happens? All of our existing customers are going to pick up the phone and call and be like, what is this? And we're like, I don't know. There's nothing worse than that. All your SDRs that you hire, it's a pain in the ass to experience. The last thing, of course, the last question you have to answer is, where's the trade-off? In early stage companies, all the way until you are Salesforce, even at Salesforce's stage, there's always trade-offs. Every decision that we make, there's going to be a trade-off. So, resources. Resources. How is this going to detract away from what it is that I've got my people doing now? Because guess what? You build a new product or you buy another company, you've got to take some of your resources and reallocate them. What are the implications of that? Is that all of a sudden now going to put you behind your competitors? It's going to create more of a gap? What's that going to do to your existing business? Really, really important that you answer these 4 questions. So first thing, look at where your product is in the product life cycle. Second thing, answer these 4 questions. You with me? Head nodding. Cool. All right, I like it. We're rocking. The next thing. Okay. Resource allocation is really, really important. How do you determine where and how to allocate your resources? I would say allocate them based on the overall market opportunity. Ooh, but then the question is how do you determine the overall market opportunity? We're going to talk about that as we get to how to transition. So, first section, we just talked about when to actually introduce new products. Here's a summary. There are 5 steps. 1, use market research and talk to your customers. Please get out there. I read an interesting statistic. I don't know if it's true or not. You guys could probably validate this. But something like 70% of product managers and engineers never meet with an actual customer. That's insane. It's totally insane. So, small company, you have customers, bring them to your office, have them meet with everyone in your organization. Better understand, it's important that even as an engineer, you understand exactly how your customers are using your capabilities. Make sure that you understand exactly the value that you're delivering to your customers. What is, in their words, not ours. Far too often, we build products for our customers that we think they want because we did it in a hackathon and it's cool. Guess what? That doesn't really turn into revenue. In many cases, it doesn't turn into revenue, but it's fun. Step number 2, make sure you're evaluating all the competitive products out there. So before you release a new product, I'm sure you probably already know this. Then, of course, determine your core product lifecycle, answer the 4 key questions, and validate the present level of demand and the best channels for distribution. So make sure you're validating. This is why this all exists. Lastly, you got to make sure you're doing your homework with an analytical sense. Okay, so that's the when. When are we going to introduce a new product? Now we want to transition into the how. But before I do that, I love this quote from Mark Cuban, which is like, look, the truth is you only have 24 hours in a day, really? And to be honest, those 24 hours should be spent on winning your core business because it will pay off a lot more in the long run. Without question. It's super easy to be distracted by the next new thing, right? The little shiny penny, I call it. It's a disease called SOD, and we all have it, especially here in the Bay Area. It's called shiny object disease. Ooh, look, squirrel. Ooh, look at what's that? New tech, new code, whatever it may be. Got to be really, really careful about that. Okay, so that's when. Now let's talk about the how. How to actually make that transition. And this is a little complicated. It's a little meaty. Don't worry, you guys have copies of all these slides, so it should be fun for us. How do we make this transition? Well, the truth is adding a new product or extending a product line to replace an existing product, one that's in decline, most likely. We do this because it's necessary for us to maintain our growth, right? But the transition's not necessarily easy. Here's something that can help make it easier. Follow these 4 steps. Step number 1, determine the specific and the exact needs of your customers. What do they want and what do they need? Back to what Patrick was talking about before from ProfitWell. And then, of course, what are they willing to pay for? It's one thing to want it. It's another thing to actually want to put money behind it. It's this transition between being a nice-to-have versus a must-have. If you're in the nice-to-have space, it sucks as a salesperson. Do you know how hard it is to sell something that's nice to have versus something that you must have as a customer? So step number 1, determine exactly what your customers want and need by market segment. What your customers in the SMB space need and want might be very different when your customers in the mid-market, enterprise, and even your partners. So be really clear about by market segment what they want and need. Step number 2, identify the products or capabilities in groups that meet those requirements and those needs. What's going to be most attractive to them? What are they willing to pay for? Step number 3, create a unique value proposition for this. This is where you need to put your marketing hat on and say, okay, well, why are they going to want to buy this? What's our positioning for this? How is this extending our core capabilities versus how is this a wholly owned different product? And then step number 4, determine the distribution channels, whether that's direct or indirect sales or distribution channels. Very simple and straightforward. This is how we start to make this transition. First, we do our homework. We understand what our customers want. We build what they want. We position it correctly. We get it out to the salespeople. Simple, right? Doesn't always work that way. I wish it did. The truth is, when it comes to allocating resources, we're going to allocate them based on product market potential, because we're talking about products that we might actually release. So how do you calculate that? The good news is there's this beautiful tool out there. Make note of this. It's called the Growth Share Matrix. And what the Growth Share Matrix does is it applies a scatter graph to rank products based on their relative market share and their growth potential. I'm going to show you what it is. I'm going to give you a real-life example. ABC Corp, right here. Their product portfolio yields these results. By the way, the circles represent the revenue potential in sales. So we got 4 categories here. You've got on the upper left, stars with product 3. On the right, question mark for product 2. Bottom left, cows, also known as cash cows on the bottom left. And then dogs on the bottom right. Let's talk about what each one of these mean. And by the way, today with your current products, put them into this category. North and south axis, market growth. East and west axis, market share, relative market share. So, product 3. Product 3 is a star. Woohoo! We like stars. Interesting thing about stars is they have the highest market share in rapidly growing markets. So what do we do with stars? Invest, invest, invest. High market share, rapidly growing market. That's a great category. It's kind of like the opposite of the magic quadrant because it's in the upper left, but invest like crazy. Product 2, question mark. There's still some unknowns. Question marks have lower market share, but in markets that are growing. So you gotta wonder, should we invest more? Should we overinvest? What are we doing with product 2? We'll answer these questions in just a second. I think there's a lot of potential for product 2 to actually become stars, but they could also become cash cows, which is fine. But there's a certain period of time where you want to stop making those investments. Product 1 is what's called a cash cow. Cash cows you have to be really careful about. You're making a ton of money off them, but guess what? The market's not necessarily growing, right? And a lot of people have a tendency of like, let's overinvest in this because we're making so much money, let's make more, let's make more. But if the market's not growing, guess what? It's not going to serve you well in the long run. So be really careful about cash cows. The product manager and the owners of the cash cow products, they're super sensitive. Don't mess with me. Give me more. Feed me more. Right? That's what happens. But unfortunately, that tends to wane rather quickly. The last product is product 4. That's in the dog category. The dog category, well, low market share and slow growth markets. So what do? Kill them. Again, if you're If you're the product manager, though, it can be personal and emotional. It's like, don't kill my baby. You call my baby ugly, and that's no fun. As you think about this growth share matrix, and by the way, it's on the public interwebs. You can go find it. Some questions you need to answer if you're just looking at this example in particular. Should we invest more in product 3? We've got great market share and high growth potential. Should we continue to invest more? Is that where we push our money? Or do we push more of our money in product 2? Can we actually take product 2 from a question mark and turn it into a star? Or even a cash cow? What do we do about our cash cow? How much more do we continue to invest in the cash cow? And then, of course, for the last one, product 4, do we kill it? What are we doing? You should plot your products on a graph like this. And again, the size of the bubble determines the potential revenue, the sales revenue. Now, your products, this also could be helpful in terms of helping you think through what products you actually want to invest in, potentially buy or build. Okay, so how do you determine what your actual market share is or could be? There's another fun little formula I'm going to introduce you to. It's called the PPH or the PPPH. Just an extra P, that's all. So here it is, product line coverage. I know it's kind of hard to read in the back. What percentage of market does the product actually target? Of the overall total addressable market, what actually percentage of the market is this actually targeting? What is that? Second P, presence. What percentage of time do you actually get to present this product? Right, so we'll call it, I'm just going to use box as an example, core box. Probably core box is talked about 95% of the time. The other products that they have, security, workflow, automation, talked about maybe 5% of the time. It's not a lead, if you will, into our customers. It's something we have to add on. So should they continue to invest in those? Some maybe more so than others. The third P is preference, and that's if you have a channel partnership or a channel distribution strategy, what preference, a percent of market share do you have with your partners? When Box did a partnership with IBM, IBM was actually reselling. They did a 10-year deal with IBM. IBM's going to resell Box. Guess what? They didn't do shit. They didn't do anything. Because they're like, we got 82 other products to go sell. Why are we going to sell this one? We don't really care. And by the way, it costs nothing compared to everything else we sell. So we didn't really have a whole lot of market share with our partners. Last one is hit rate. How often do we win when we're actually out positioning this product? If you multiply all these, you will get a market share factor that can be used to evaluate the effect of different market strategies. Cool? Don't worry, this is all on a deck. You can study it later. This is a lot of information to try and absorb. We talked earlier about when. Now I'm going to give you a little summary on how, and then I'm going to give you some things that I've learned not to do in my last 60 seconds, and then I'll open it up for questions. Cool? You with me? More head nods. Okay, I see most. Okay, good. All right. 4 things. To make this transition, the first thing we have to do is make sure you follow the 4 steps. What were the 4 steps? Do your homework on your customers, understand what they want and need, make sure you actually deliver on that, build out your messaging and positioning, and then, of course, make sure you're clear about your distribution channels. How are you going to get this product to market? Second thing, allocate resources. If you're going to allocate resources, you have to understand the growth share metrics so you understand where you're going to invest. Where does your existing product today live? Is it a star? Is it a cash cow? Is it a question mark? I don't know. If you don't know that, then how do you know where to invest? Therefore, how do you know when to release or launch a new product or buy another company? If you don't know where existing products actually live in this growth share matrix. And then number 4, use the PPPH model to evaluate the effects of your marketing strategies. Woo! We covered a lot. When to actually launch a new product or actually buy a company, how to actually do that. Now I'm going to tell you what not to do. This is the fun stuff, because this is the stuff that actually affects me on the go-to-market side. Number 1, there are 8 things not to do. I will go through each one. Number 1, please do not launch a product without actually engaging marketing and sales. Period. Don't even start thinking about launching a new product without actually introducing marketing and sales to the idea. Because I can tell you what, they have their own set of priorities. You have your set of priorities. The more siloed you become, the more difficult it becomes to actually get these things to market. Number 2, do not launch a product without educating sales on the product itself. Do you know how hard it is when there's an announcement? Oh, so it launches this whole new product, and the SDRs are fielding calls on this new product. They have no idea what it is. They don't know how to talk about it. They don't know how to sell it. They don't know how to position it. They don't know how to price it. They don't know how to handle objections. They don't know who the competitors are. It happens all the time. It's terrible, terrible, terrible idea and practice. Number 3, do not launch a product without actually having the right assets or materials available for the rest of the organization. It's one thing to have the assets available to the masses. It's another thing to make sure that your internal folks, especially customer support and customer success, because they're the ones with the closest relationship with their customers, they have to understand what's going and how everything fits together. Number 4, do not launch a product without customer validation on price. Go to ProfitWell. Help engage them to help you figure out what the price should be. Number 5, do not build a product without meeting with customers. Period. I should put that all in bold. You cannot launch a product without meeting with a customer. Number 6, do not launch a product with just your partners. That's just weird. Your direct sales organization is like, why are our partners actually selling something different that we sell? It's all under the same company umbrella. Unless that's your model, unless 98% of your revenue is going through your partners, then maybe that's different. Number 7, last 2, do not launch a product before your core product actually reaches maturity, unless you feel the need to launch a product when you're in the growth stage to offset or block and tackle a competitor. That's the one caveat. It's okay to do it in the growth stage, certainly not in the introduction stage. You're still trying to pull your head out of your big toe. But in the growth stage, you may need to launch another product or buy another company to block off your competitors. And then number 8, do not launch a product. Do not launch a recent product that was. Do not launch a product that was just recently built at a hackathon, because most of the time that's just cool factor for you internally, and it hasn't really been validated or tested with your customers. And oh, by the way, go back to number 1. You're not going to do that because you need to get marketing and sales involved and everybody else in the organization involved, even though it might be really cool and it's solving a problem that you guys have been struggling with for a really long time. That was a lot. You'll have the deck. I've got 46 seconds. Questions? Yes?
What about in the early stages of a company when you're not sure what is a question mark versus a star? I would say this is very relevant in that pre-product market fit stage, so maybe this is kind of
Yeah. So pre-product market fit, you're not necessarily, you don't have enough customers to say, well, is this an actual question mark or a star? Because you just don't have enough revenue. and you don't have enough repeatability to say, well, do we continue? Because when you're in that pre-product market fit, all your investment is going there. And oh, by the way, in the pre-product market fit, you're in the introduction phase, right, of your life cycle. That you should be focused on one product in that phase, right? And it's not until you get enough traction that you can go, okay, this might be going over to the dog category, or this actually it might be turning into a cash cow. It's just really important to recognize that it could fit in other places. Because if it starts to turn into a cash cow, it's easy to get blinded by the fact that you're generating a bunch of revenue from it, but the market itself may not necessarily be growing, it may be shrinking. Right? So at that stage, you're like, okay, cool, we're going to make a whole bunch of money off this. It's kind of like companies that launch a consulting business, and then they build a product. And it's like, I'm going to keep doing the consulting business to feed the revenue to build the product. Right? So the consulting business is kind of like the cash cow, if you will, and then I'm building the product so that I can turn that into a question mark and maybe hopefully a star. Cool. Yes?
You mentioned to tackle the one battle at a time. So what do you think about the disadvantage to introduce a new product in the decline stage?
So decline stage. Yeah, when you introduce a new product in the decline stage, you kind of have to go through the process of re-educating the whole market itself, right? Because the market knows you here, the product's starting to decline. It's almost like Oracle. Like, think about Oracle, right? I used to work at Oracle too, by the way. Woohoo! What does Oracle do to kind of maintain their margins? Right? They buy companies. When one of their product lines is starting to hit that decline phase, they're like, well, how do we relift the company or relift the product? They go out and buy somebody, most likely, most often. Once you've hit that decline phase, if you have nothing else already in the works, then it's just more work to get back up to that growth and maturity phase with a net new product. It just takes longer. Okay, I'm at Doug Landis, or just Doug@mcap.com. Find me on LinkedIn if you have any questions. Thank you guys so much for your time. Appreciate it.